For most people, financial systems feel stable and predictable. Banks store money, businesses grow, markets rise and fall, and the global economy moves forward. But throughout history, there have been moments when that sense of stability suddenly shattered. Moments when fear spread faster than logic, when investors rushed to withdraw their money, and when entire financial systems began to collapse almost overnight. These moments are known as financial panics, and one of the most shocking examples in history revealed just how fragile the global financial system can truly be. A financial panic begins with something small. Often it starts with a rumor, a failed company, or a sudden loss of confidence in a financial institution. At first, only a few investors become worried. They start selling assets or withdrawing their money from banks, but finance runs on confidence. The entire banking system depends on the belief that money will always be available when people ask for it. When that belief begins to crack, panic can spread quickly. Investors rush to protect their wealth, banks struggle to provide liquidity, and markets begin to spiral. One of the most dramatic financial panics in history unfolded during a time when the global economy appeared strong and unstoppable. Businesses were expanding, stock markets were booming, and people believed prosperity would continue indefinitely. But beneath this optimistic surface, the financial system had quietly built up dangerous levels of risk. Banks had issued massive loans, investors had borrowed heavily to buy stocks, and complex financial instruments had tied institutions together in ways that few people fully understood. Then something unexpected happened. A few financial institutions began reporting heavy losses. At first, many people dismissed the warnings. Market optimism was still strong, and most investors believed the situation would stabilize quickly. But as losses grew larger, confidence began to evaporate. Banks suddenly became cautious about lending money to each other. Investors rushed to sell risky assets. Credit markets began to freeze. The panic spread rapidly through financial markets. Stock prices began falling sharply as investors tried to exit the market before losses became even worse. Banks tightened lending standards, making it harder for businesses to borrow money. Companies suddenly found themselves unable to finance everyday operations. Within a matter of weeks, what had started as isolated financial problems had turned into a global crisis of confidence. One of the most frightening aspects of a financial panic is the speed at which it spreads. Modern financial systems are deeply interconnected. When one part of the system begins to fail, the effects can ripple across the entire economy. Investors start questioning the stability of other institutions. Financial markets become volatile, and governments suddenly face enormous pressure to prevent a full economic collapse. During the height of the panic, fear dominated the financial world. Investors watched their portfolios lose value almost daily. Banks struggled to maintain liquidity as customers withdrew funds. Businesses delayed investments, cut jobs, and reduced spending. In many countries, governments and central banks were forced to take extraordinary actions to stabilize the system. Emergency loans were issued, interest rates were reduced, and massive financial rescue programs were introduced in an attempt to restore confidence. These interventions were designed to prevent the panic from turning into a complete economic breakdown. By injecting liquidity and reassuring markets that key institutions would not fail, governments were able to slow the downward spiral. But even with these measures, the damage was severe. Stock markets lost enormous value, businesses collapsed, and millions faced financial hardship. Financial panics reveal an uncomfortable truth. Modern financial systems are powerful, but highly sensitive to confidence and trust. When people believe in stability, capital flows smoothly. But when that trust disappears, the entire system can become unstable with surprising speed. Economists and policymakers study these events carefully because each financial panic provides important lessons. Stronger regulations and more transparent markets are often introduced after crises in an attempt to prevent similar events in the future. Yet history shows that financial systems have a tendency to repeat familiar patterns. Periods of growth often lead to increased risk-taking. The financial panic serves as a reminder that the global economy is far more complex and fragile than it appears on the surface. Behind the daily headlines lies a vast financial network built on trust and confidence. When that trust is shaken, even the strongest systems tremble. History suggests panics will almost certainly happen again. The real question is whether the world will recognize the warning signs early enough.